Hi, this is Dan Kerr's DK Analytics. It is September 4th, 2019. Thank you very much for tuning in. Today's video has a bit atypical topics consisting of a confession, an appeal, and a wild ass thought. When I say wild ass, we can consider wild donkey in case the political correctness police are out and about. Jokes aside, let me get right into it. A confession from someone that grew up Catholic concerning my video efforts. It sometimes takes me a while to hit my stride as I start my videos, as you've surely noticed, anyone that's watched them for a while. This may be a turnoff. I apologize for that. And I will try to improve, at least incrementally. But trust me on this. My videos typically have a nice helping of well-supported where's the beef observations, callouts, and food for thought, if only you have a bit of patience with me. Which brings me to my appeal. For those of you that tune in and are waiting for content red meat, may I ask you to either hang on for a few short minutes, or if that is a cheeky, outrageous non-starter request, please take your mouse and go into the heart of the video, and you are likely to find something you can chew on a bit, which you might not find immediately digestible once it's swallowed. Arguably, good food for thought isn't, you know, kind of like red meat. And when I refer to content red meat, I don't mean to sound sensationalist in the least. Rather, I hope that you find my backed by sources 2 bits worth beefy enough to warrant a few minutes of your valuable time. And if this is the case, I'd be grateful if you'd tell others about my little YouTube channel. Moreover, and call me outrageous, but if you approve more than you disapprove of what you hear, a thumbs up would help me get my channel off the ground a bit, given how YouTube allegedly does business. As to my wild ass thought, which is really just a minor portfolio reallocation thought with huge valuation implications, I won't keep you waiting too long. See, I'm trying. Here goes, but first a bit of framing. You know how sometimes while you're mowing the lawn, cooking dinner, cleaning up, or driving someplace that doesn't require every last ounce of your attention, all kinds of thoughts race through your mind. I've had one repeatedly. It's this: would much, much higher gold and silver prices really only be possible in a doomsday scenario, as described by even much more massive Banana Republic style money printing throughout the OECD world, or in an all-out trade war metastasizing into a shooting war, or in a full-fledged global recession with rising consumer prices, otherwise known as stagflation, or perhaps in a full-fledged socialist takeover of the US government or other Western governments, which would threaten even greater property disenfranchisement, or amidst increasing and tragic numbers of homeless people in the US and elsewhere, perhaps causing increased OECD nation civil unrest or strife, or perhaps due to some other horrific events or sequence of events conspiring to eradicate confidence, positive expectations, economic growth, and the very profits which are used to pay creditors and to justify stock valuations for shareholders. Said differently, a 5 to 10-fold higher dollar gold price per troy ounce and a 10 to 20-fold higher dollar silver price per troy ounce may not only manifest themselves in a truly grisly, even more dysfunctional, tragic world, it could, and I would argue it should, manifest itself prior to that. That is, prior to ugly fireworks, courtesy, once again, of a minor global portfolio reallocation and functioning price discovery displacing manipulation. But, and here's the point, there is a universal consensus that hugely higher gold and silver prices would have to reflect ongoing Armageddon. I'm going to dispute that here with my wild ass thought or point. For very loose comparative purposes, and to hopefully help build a small and only partly representative foundation for my point, all of you are certainly well aware of the crypto bubble, and I hope a lot of you made a ton of money. I didn't make a dime. I didn't play. Well, I still think cryptos are in a bubble at today's crypto unit prices. I struggle to call them currencies. For reference details, please see post 23, Precious Metals versus Cryptocurrencies and Good Money, which I uploaded onto the DK Analytics site on 12/11/2017 when Bitcoin was over $16,500. A share? Is that the right word? You know what I'm saying. The post may be dated, but I think the arguments are as valid as ever. Have a look. I'm serious. Why reference the crypto bubble, you may be thinking? Because it was initially and primarily based, its alleged claim to fame or its raison d'etre was to establish sound money alternatives to government-controlled and manipulated fiat currencies and the associated long-standing and worsening monetary debasement, electronic money printing, as well as the privacy violations that investors, savers, and consumers wanted to sidestep with alternative currencies. So, what happened as this crypto bubble got bigger and bigger in 2015 and 2016, having gone ballistic in 2017, and then peaking in late 17 at dizzying levels? For example, Kingpin Bitcoin was 24 times higher in late 2017 than in late 2016. During these 3 years, 15, 16, and 17, did the dollar plummet? Did other OECD currencies plummet? Did gold or silver in dollar terms spike? Did oil in dollar terms spike? Did commodities spike in dollar terms? No, 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 and no again. What's my point? Expensive digital air crypto wannabe currencies went orbital, but hardly any of the currency debasement concerns were registered in the mentioned currencies and the assets valued in those fiat currencies. Why not? In my opinion, because cryptos by themselves aren't stores of value or usable money that shield people from currency debasement and privacy violations. They are speculative assets lacking any intrinsic value, but instead represent huge energy cost sinks just to sustain. Quite the contrast, I might add, to above ground gold and silver. This prompts my question about crypto wannabe currencies going orbital. Why couldn't the same happen to gold and silver, if only in a diluted sense, without everything hitting the crapper. Not that we're not headed for the crapper, don't misunderstand me, but before we get there, that's my point. Rare above ground gold and super rare above ground silver, a lot, if not most of silver, is scattered about in tiny, expensive to retrieve bits in junkyards. So rare above ground gold and silver, which is what I'm trying to drill down to, constitute less than 1% of global investable assets, possibly below 0.5%. Therefore, just a small move into scarce gold mined at about a $160 billion US dollar rate annually, or 3,200 metric tons, or 103 million troy ounces, and even scarcer silver mined at about a $17 billion annual rate at current dollar silver prices, or 856 million troy ounces. If demand for these metals moved up, given the small mined output, it would send equilibrium prices of both metals into the stratosphere if investable portfolio funds, thought to total about 250 trillion globally, decide, or that is the money managers running them, decide to move up allocations to precious metals by only 0.5%. Or let's even say by 1%. And I'm talking about percentage points, from a 0.5% allocation to 1.5%. For round number ease, increasing exposure by 1 percentage point, or roughly 2.5 trillion, 1% of 250 trillion, I mean, these are just unbelievable numbers and I'm glossing over them, I don't mean to, but that would be the rough equivalent of 16 years of gold mining output at current levels of annual extraction if mining was the only source. Obviously, it's not. But what I'm trying to say, or to repeat, is simply this. The only way that global investable funds can up their aggregate precious metals exposure by 1 percentage point in a short period of time, from again, say 0.5% allocation to 1.5% allocation, would be via a much higher gold equilibrium price. Silver, as gold's little brother, would be dragged along for the ride. In fact, given silver's growing industrial demand, silver's relative scarcity, recall that silver comes out of the ground at only about 8 to 1 to gold, yet the silver to gold ratio is 80 to 1 currently. And lastly, given silver's stout strategic remonetization prospects, highly volatile silver will likely outshine gold significantly in the repricing of precious metals that appears to have commenced. On the remonetization front, note that U.S. silver certificates, erstwhile U.S. dollar bills, were redeemable in silver to the bearer on demand from 1878 clear through until 1964. And I'm not going to mention that silver was money for the Romans and the Persians. It's been money for a long time, and I'm saying it could be again, which would be substantial icing on the silver revaluation cake. That's the takeaway. For historical precious metals allocation reference, please note that investors have traditionally had a 2 to 3% allocation as a part of their investable assets to precious metals. Swiss private bankers, back in the days when they worked for clients first, used to call for 10% exposure. Where am I going with all this? Simply here. I dare state that the end of the world need not be nigh if precious metals prices went through the roof, given the extremely slender global portfolio allocation to precious metals on the one hand and the relative scarcity of precious metals on the other hand. Conceivably, we could see a portion of the 20 to 50-fold plus crypto valuation explosions of a few years ago in precious metals, except this time around, that portional upside won't be in fool's gold, for ultimately fiat currency destroying central banks will have to revisit, yes, revisit 20 to 40% gold backing to restore confidence in their currencies. That is, if it can be done at all. Translations, they will have to print money to buy the gold. That's the translation. Better than buying government junk bonds and putting them on central bank balance sheets. Wouldn't you agree? Now, given the global monetary base expansion over the last 10 to 11 years of somewhere between 16 trillion and 18 trillion dollars, with lots more in the works, and tethering gold to the global money supply, which, by the way, would reflect the global monetary base expansion given a drooping global money multiplier, such money supply backing would imply a gold price of over 5,000 US dollars per troy ounce at 20% global money supply backing and over $10,000 US dollars per troy ounce at a 40% global money supply backing. And this is all before queued up monetary base expansion in the pipeline triggers further central bank balance sheet bloat, which will ultimately reach the money supply for a variety of reasons, which I reviewed in the August 31st video a few days ago in considerable detail, and which I have often covered in other videos and posts. In fact, I go into this very topic in quite some detail in post 23, page 10, that December 2017 post on cryptos and good money that I referenced before. And if all these reasons fail to manifest themselves in terms of germinating higher fiat currency, gold and silver prices, rest assured that over time, our fiat currency destroying central bankers / central planners have the printing capacity to get what they all perversely want, namely higher inflation or more rapid currency debasement. As such, it's not a question of if, only when, as history clearly shows over more than 1,000 years and common sense dictates. In such a world, our world, both gold and silver ought to be much, much better bets than more digital fiat currencies, which can be created out of thin air. How many new cryptos have been created, I ask? Moreover, note that the blockchain-based currency alternatives being explored / developed by the likes of China and Russia will not only be government controlled, who would have ever thought that, but they will likely be precious metals backed. In other words, that's what gives otherwise empty, energy sucking crypto shells their value, their only value. I'd be remiss if I didn't verbalize a closing thought for those of you thinking about what I'm not addressing. You'll correctly note that professional money managers hate physical gold for a simple reason. They can't earn a dime off of it. They can't charge money management fees on it like they can on paper assets. including not just bonds and stocks, but paper gold. Moreover, money managers would have to figure out how to store physical gold safely. Okay, huge headaches, no incentive, forget it. Got it. But, and you knew this was coming, they can buy physical gold and silver backed ETFs or funds, right? The only question here is how much of those physical gold and silver claims will ultimately prove to be physical metal backed. Typically, not much. In aggregate, perhaps 1 troy ounce of gold or silver for every 100 paper troy ounces, perhaps even less, perhaps substantially less. Will this stop money managers from seeking such paper allocations to precious metals? Naked paper allocations? No, of course not, because they have a monetary slash compensation incentive to do so. That said, someday there will be a failure to deliver the physical, the underlying asset for a big kahuna. Now, those silver ETF shareholders or fund shareholders are privy to what they bought via the documents they received, which listed the contractual obligations of the ETF or the fund. Specifically, the purchasers, the investors, if they read the small print legalese buried somewhere in the prospectuses that the ETFs or the funds that purport to sell physical gold publish, there is this little detail in those prospectuses or similar documents that state that in case of a non-delivery of physical precious metals situation, they don't have the metal, that the ETF or fund shareholder is ready to accept the cash equivalent of yesterday's closing price of the purchased metal times the shares held. Should the investor demand physical delivery, but the ETF or the fund is supply short? In a snorting bull market with precious metals demand outstripping supply, the paper gold and silver charade will not only be exposed as largely non-deliverable, unfulfillable contracts, but the related we don't have the physical precious metal exposure discovery by investors that thought they were buying physical gold and silver will probably cause even more supply constraint concerns, which will likely vault demand for physical gold and silver higher still. Storage issues be damned for the moment. What this will likely do for gold and silver prices is pretty clear. Maybe the OECD central bankers will be late to the gold revaluation party. Maybe the private sector will beat them to the punch once again. Perhaps the central planners will have to pay up even more. But what the hell? They could just print the money with which to pay. By the way, on that wonderfully largely fraudulent paper exchange as regards precious metals, namely the COMEX, gold last time I looked was at 1564 per troy ounce, $1,564 per troy ounce, and silver stood at $19.71 per troy ounce. Bottom line, the takeaway, perhaps my wild-ass thought about a precious metals revaluation prior to the world coming to an end isn't so wild-ass after all. In fact, it would be consistent with precious metals' historical thermometer qualities. Is the economic and financial patient healthy or not? Are there property rights or not? That historical thermometer quality or qualities have been squelched thanks to sustained and material paper price manipulation, which we all know can't last forever. I want to thank you for tuning in, and I want to thank you for considering my appeals, including the one about sharing my channel address, my YouTube channel address with friends, and the other one about possibly giving me a thumbs up if you like the video. In a related manner, and most obviously, if there's more you dislike than like, then the option, the thumbs down option, is sitting right next to that thumbs up choice. One brief correction to my last video. I mentioned that there was a lot of fluff in US GDP in that August 31st video, including $2 trillion in regulatory compliance costs. Those costs represent nearly exclusively wages paid, which are not in GDP, but are aggregated, as you might guess, in gross national income, which is the theoretical equivalent of GDP. Sorry about that. This is Dan Kurz of DK Analytics. It is September 4th, 2019. I am trying to sign off here. Bye-bye. Thanks for listening.